In this video, we're going to talk about call options and how you could use them to make money even when the market is going down. Call options. You may already be familiar with them, but let's go over what they are really quickly. The call option gives a buyer the right, but not the obligation, to buy 100 shares at a certain price on or before an expiration date. So that is what a call option does for the buyer's perspective, but we're going to talk about the seller. And this is where I think a lot of money can be made without really gambling, and statistics are actually on your side, and I'll show you in this video. So all this is from the buyer's perspective. Now let's look at the seller of the call option. Because these two are counterparties to each other, as in if someone bought it, that means someone had to have sold them the contract. And so what would happen is the seller is actually obligated to sell 100 shares at a certain price, this price, and at this expiration date. Because remember, they are counterparties. So for this buyer, this person sold them the call option. Notice how this person's buying 100 shares at a certain price. The seller is actually obligated to sell them 100 shares at a certain price and on the expiration date. And they accepted this obligation because the buyer actually pays the seller something known as a premium. This is actual money that gets deposited into the brokerage account. In this video, we're going to talk about the seller's perspective and how you can actually make money when the market goes down through selling call options. So we're going to look at a strategy called the naked call option. Let's say right now a stock is trading at $100. This is the current price. What you could do is, if you are bearish, as in you think the stock's going to go down, you could actually sell something known as a naked call option at the $105 strike price. Now, when you sell this, you get to collect a premium. And who do you get this premium from? The call buyer. They pay you the premium. If you remember this, the buyer is paying a premium to the seller. And in this example, we are the seller. And so as long as the stock stays below 105 at the expiration date, and if you remember, the expiration date is an extremely important part of the definition. And let's say in this example, it's 30 days. That means if the stock stays below 105 over the next 30 days, you get to keep this entire premium. And that could be a sizable amount of money. However, if the stock goes above $105, you become obligated to sell 100 shares at 105. So there is definitely a risk here. So the stock could be trading at $120. And if you sold a naked call option, the risk is you would have to sell the stock at 105. And the problem is, if you don't own the stock when you initiate this position, that means you have to go into the open market to basically buy the stock at 120, and then you would sell it to the person who bought the call option at 105. So by doing this, and if the position goes against you, you would be down $15 in this example. You would still get to keep the premium. So let's say the premium is a few dollars, so you'd still be down like $13 times 100 shares. So you would be down $1,300 in this hypothetical example if you sold a call option and the price went against you and it expired up here. So that is the biggest risk. But the positive is, if you are bearish and the stock right now is only trading at 100, you can actually make money if the price continues going lower, and you get to keep the entire premium. The only way you can actually initiate this position is if you have something known as a margin account. This is absolutely required to enter into naked positions. What a margin account does is you can borrow money from your broker. You could technically lose more than your initial investment. So this is actually an advanced strategy. It's not for beginners, and you must practice aggressive risk management. But if done properly, you can get some very handsome rewards. Now, I may have spooked you because this is a pretty aggressive strategy and pretty risky strategy if you don't know what you're doing and if you're not managing risk properly. But there are ways to actually use the same strategy while reducing risk significantly. You could actually check out that video right here.